get in. Looks like our attendees are piling in as we go. We'll give it just a few minutes, and then we'll get started. The numbers are filling up quickly. All right, I think we got plenty to get started now, so we're going to get started. First off, I'd like to welcome everybody to today's Cinch Series webinar. For those of you who are new clients or simply new to the Cinch Series, these are exclusive webinars for Cinch IT clients only. They're meant to educate and train each of us on a variety of topics, okay, to help us improve and grow our businesses. Most of these, in fact, are not about technology at all, but we bring in other expert speakers to talk about ways that we can improve and grow our business. We do this because we consider ourselves more than just your IT company. We truly consider ourselves your partners. Your success is our success. Before we get started, just want to go through a couple housekeeping rules. First off, all attendees are in listen-only mode today. You will notice, though, that there is a chat box on the right-hand side of your screen. Today, all chats are completely private. There's no public chats, so feel free to ask any question. There is no such thing as a silly or stupid question, but today, more importantly, they're all private conversations. We'll save all those Q&As for the end, and then we will go through all of them and make sure to get to all of your questions today. So let's get started. First off, I would like to welcome everyone and introduce today's presenters. They are long time partners of Cinch IT, and it's my pleasure to introduce Managing Partner Terry Shepard, as well as Senior Consultant Matthew Allison and CPA and Tax Manager Matthew Anderson. S&G is a professional group of business consultants and certified public accountants. And I couldn't think of anyone better to present to us today and to answer our questions regarding Payroll Protection Program and the CARES Act. So Terry, I'm going to turn it over to you and let you get started, sir.
Great. So thank you, Rick, for the warm invitation or introduction, I guess, that we're going to talk about. And good afternoon, everybody. So everybody's heard, obviously, by now about the CARES Act and $2 trillion that the Congress put through. To Congress's credit, and I know they get a lot of blame for things, but to their credit, they really did work really hard to try to get this out as fast as they could to make sure they got money into both businesses and individual hands to get through this crisis. And unfortunately, their dates of implementation were also on the fast track, and they did not have regulations, instructions, et cetera, out before the date. So they happened just the night before, and they came a day later. They're still coming out, and there's been a lot of fine tuning and changes. So it's been a frustrating process for, I know, our clients, and I'm sure a lot of the other business owners like yourselves, and certainly it is for the banks that they've had to cram real quickly and then constantly change as SBA has come up with further clarification. So first of all, these loans are made directly by the bank. So it's unlike the first disaster loan act that they had out where you apply directly to the SBA. These loans are made right by the bank. So the SBA then approves the application, but then it goes back to the bank and they do the paperwork to have everything documented and signed before the money is released. It's guaranteed 100% by the SBA. And so with unknown instructions, the banks have been very protective of their risk management, that although they've been told to take the applications as they are coming in and being certified by the business owner, if the loan goes bad and the SBA comes in and they find that they did not follow the letter of the law of the act and all the regs, then they might not be guaranteed for that part of the loan. So Some of them have been taking very conservative approaches, and there has been some inconsistency. And I know the accounting profession is trying to get that taken care of. So we only have one set of rules that everybody's playing with. The loan applications, hopefully all of you have already put your application in. They've started for small businesses and the sole proprietors, and then the independent contractors and the self-employed start tomorrow. As we go through the list, and Matt Allison later on tells you exactly what kind of information you need to submit with it. Hopefully, if you haven't submitted something right after this webinar, you can start pulling the information together. Next slide, please, Rick.
Yeah, Terry, if you'd like to, we do have a poll ready to go if we want to get an idea of where everybody's at as well. Do you mind if I publish that poll real quick?
Yeah, right. That'd be great.
Perfect. So I'm going to publish a poll right now for everybody that's on. I just did. You should see it in just a second here. And we're curious where you are in the application process. Have you not started it? Have you already submitted your application? Are you wondering what's next? Or are you like many of us and have no clue just yet? We'll give that just a minute, Terry, and then we'll continue on. The good news is it looks like, for the most part, most of the clients have submitted their application. I'm kind of wondering what next. We do have about 20% that have not yet submitted. I think that's going to be, they'll get a lot of value out of it today. I'm surprised. Nobody says they have no clue. Not yet. I'm waiting for that first brave soul. All right, we'll end it there. It looks like for the most part, about 75% have submitted, 12% are wondering what next, and another 12% haven't started yet. So thank you, everybody, for that feedback. Hopefully, Terry, that's helpful for you and Matt and both the Matts today.
It is, so we can go to those areas that people need the most information on, and not stay on other things that they've already done if they've already got through their application. So for those who haven't got it in, that I think you said 12%, make sure you contact your banks immediately. Again, right after this webinar, because money is going to be running out, which is the last bullet. They've been inundated. The banks have been inundated with applications. The SBA's already approved quite a bit of the $349 billion, and they're already talking about providing a second go at it, because they know this money is going to run out rather quickly. And if hopefully you have loan relationships and with your bank that actually is an SBA approved lender, because they're giving priority to their existing customers. And I don't even know if some banks are going to take anybody in that's not a customer, because then they have to go through a lot more verification that your company really exists, because it's going to be subject to a lot of fraud. Everybody knows it. And again, that's something else that if they don't verify it, they're going to be at risk for any loans. Next slide, please. Eligibility, you have to be in business by February 15th, 2020. I think everybody's got the handle on small businesses with fewer than 500 employees. And if you're a nonprofit, that also applies for you. And so we already know who qualifies. I think from everybody's majority has already put their applications in. Rick, next slide. It waives the aggregation rules of affiliated companies, and that's just used to determine the number of employees to make sure you're under 500. They've done that. They separated that for the hospitality and restaurant businesses, obviously, because they've just gotten clobbered. And then when you're doing this, part-time and temporary employees are all counted the same as full-time employees when you're doing the test that's later on for the eligibility. Next. Special rules. Obviously, this is great for borrowers. It waives the collateral. Usually, the SBA takes real estate and the guarantee requirements. Waives the substantiation that you can't get credit elsewhere, which is what the other disaster relief program calls for, and it waives any of the borrowing fees. There are some certifications for those who are ready to put their application in, that this is necessary in light of the crisis, which I think most businesses qualify, because we don't know how long this is going to go. And I'm of the opinion it's going to go longer than the early May that we now have in Massachusetts to stay inside. Acknowledge that the funds are going to be used to retain the workers. I mean, that's why this PPP program has come into place, and you'll see the emphasis on that, on some of the restrictions of what you can use this money for and the forgiveness portion later on. And then you can't have another application in with the SBA that's covering the same type of costs that you're looking for now, which is obviously the payroll related costs. And then you have to document and verify the number of employees you have. Next slide, please. To me, that's a pretty simple calculation, although it's been misinterpreted by quite a few people, including some of the banks. You're looking at your total payroll costs, and for the 1 year prior to the loan, you're going to be taken out by 2.5 up to a maximum of 10 million. Now, although it says before the date of the loan, a lot of the banks, and I believe even the SBA regs when they first came out, have been taking the calendar year, because those 941s have already been filed. It's verifiable. And so and then I just saw the other day that some banks are taking the first 9 months, or the last 9 months of 2019 and the first quarter of 20, and they're going to have to verify it by other means if the 941's not done. So each bank might be asking for a little bit different backup. The seasonal businesses, you can see the time periods, and if you're not in business, there's another separate time period to do the calculation. Next slide. So the payroll costs, the first 4 have to do with actual the payroll items, salaries, and you'll see some confusion in the use of the term of payroll costs, salary, and wages, and payroll, because they have been used interchangeably, but they have each one of those has a different definition, and so it's really confused of what's included or not in the calculations. You can also obviously add in the health insurance, your retirement benefits, and the state and local taxes. There are some payroll companies that were including the employer's FICA portion, but that's not allowed. It wasn't allowed in the law, nor is it allowed in the regs and the rules that have come out subsequently. Next slide. So the payroll cost exclusions, the payroll cost, that should say salary, wages, doesn't exceed $100,000. And so it is salaries and wages. Some of the banks, I know one bank in particular was looking at payroll costs it included all the payroll costs that were just listed on the other page, and they were maximizing that at 100,000 when they were doing some of the calculations. So that's now been clarified by the SBA that it is on salaries and wages only. The compensation has to be paid to someone who's a resident in the United States, and you have to make sure that the wages, you're not getting a credit for the qualified or family leave from an earlier act that was enacted. Next.
One question for you, Terry, we got that I think you can probably address here. We got a question that says, can you please confirm that the payment of retirement is just employer match?
It is.
Okay, perfect. Thank you.
So the allowable use of the proceeds are all those six items that were under the payroll costs. That's what Congress wants you to use it for. And if you go outside those lines, as you'll see, then that portion's not going to be forgiven. There's some redundancy here because it talks about the health care benefits, and the salary is $100,000 in rents and utilities, and it's certainly included under the payroll cost definition I had it at above. It also has any interest on mortgages you might have had, and if you didn't have mortgages, then that's why rent's included. And if you had any other debt obligations before February 15th, then it could also be used to cover some of that interest. Next slide. So this is the crown jewel right here that you can use, get this money, have 8 weeks of monies to pay your employees and some of the other identified expenses. And if you meet their dual requirement, then the loan's forgiven. That doesn't happen too often, obviously. So the borrow dual, again, the essence of what the act is they want you to retain employees and anybody you've laid off to bring back in. And the amount is equal to the amount spent during that 8-week time period. Next slide, please. So once you have that, the amount that is eligible, then it's going to be decreased by two things. So one, if you have less employees now than you did the year before, then the loan's going to be, the forgivable portion is going to be decreased by that ratio. And if you have more employees, then obviously that's more than 100%. And that's why at the third bullet there, it says loan forgiveness cannot increase the formula. So we need to make sure that the FTEs are equal to or greater, or know that some of the loan is not going to be forgiven. And if some businesses, which I know some of them did, of maybe making cuts across the board to make sure it was the pain was equal. And if you cut anybody's salaries more than 25%, and that has to be taken out also of the amount of the forgiveness that gets decreased too. So you're going to have to pay that back also. Next slide. Now, is this exception? So you can rehire anybody that you let go, and if it's not the same person, as long as you bring that body back in, an FTE, and that's what the calculation is based on. So you don't have to rehire anybody that might have quit or left for whatever reason. You just have to go try to scurry around and find someone to bring in. And if you've lowered anybody's wages, lift them back up again. Give the wages to what they were. And if that happens before June 30th, then you're covered under this loan forgiveness, and you don't have to be subtracting what you didn't spend out. A real critical point is the non-salary allowable expenses can't be any more than 25%, because if they are, then that part's not going to be forgiven. The Congress wanted to make sure that the employees and the U.S. citizens had paychecks in hand to be able to survive, and they want to make sure you're using this money to that purpose. And anything that is forgiven, again, another one of the crown jewels is you don't have to bring it into income.
One of the questions we got, Terry, was why is unemployment paying everyone a flat $600 fee, even if they might be lower wage employees that don't make that normally? Isn't that contradicting this program?
I know that they increased the whatever they were supposed to have gotten. I thought by the old rules, Congress allowed an additional $600 to go to that person, so they're getting almost full salaries. I don't know if they're just giving out $600 and above what their full salary is. I have not gone into those details, but that's what the law had stated. I thought it was going to be file your unemployment claim. That's usually not 100%, and they added $600 per individual to try to bring them up whole, is what my understanding is. But and maybe when Matt Anderson gets into it, he might have a different answer than I have, but that's my understanding.
Got it.
And then the key low term. So if the loan's not forgiven, that portion that's not forgiven, you got to pay it back, and it's a low rate, so that's nice. It's 1%. The first 6 months you don't have to pay back the principal or the interest, but they did shorten the time period. The act said it could be up to 10 years, but the SBA and Congress really want to make sure that the borrowers are using it to keep employees whole, and they want to make sure that they are being paid. And so they put this on an onerous portion, which I think that is deservedly. If you don't use it properly, you need to pay this money back within 2 years. So I think that would keep most people pretty honest. And the forgiveness portion, by the way, that hasn't been detailed yet as to how you're going to certify that. And but there's some ideas coming out, and I know that S&G, we have a conference tomorrow to see how we're going to follow through the forgiveness of tracking. But they expect there's going to be a lot of fraud, and so there's going to be very strict tracking on this forgiveness amount to verify the salaries that were paid and the other costs. I'm assuming they'll want canceled checks, obviously the payroll records. You know, we're kicking around the idea now of recommending setting up a separate bank account to put the loan proceeds in, and then they just spend those 6 required items from that account only, and track between the 75 and 25. But we anticipate it's going to be onerous. I think the banks are. We'll have to wait and see until we get more information released by the SBA.
We do have 2 questions there, and if anyone wants to field them as well. But one of them said there, a lot of people are saying a lot of the same stuff. Things like many employers that are out there cannot afford to necessarily hire back employees until they get approved and that they've received that funding. Have you guys had similar conversations with any of your clients, and what has been your guidance or advice on that?
Sure, and as long as you're hiring back before June 30th, then it meets one of the 2 requirements, right? And again, you still have to spend that money within that time period. Whatever the government has approved you on, you need to spend that money on the salaries and the other allowable expenses. And if you didn't, then because you're waiting and it's a shorter time period, then you'd have to give it back. But the loans are going in now, and if they're approved, I don't know if they're going to be. The 3 days is definitely out at this time. The SBA has come out within, funding within 10 days once they're approved. It might be a couple of weeks until they get this, because there's going to be all of these applications that are coming in. The banks now have to do documentation and then get every borrower in to sign these before they release the funds. So this is going to be a little bit of a process to get through that opening gate. And then maybe after we start filtering through the first application rush, maybe it'll start smoothing out a little bit, and it'll be a little bit shorter time period. But as long as they hire back, and you've got 8 weeks, right? So you still got all of May and June. So even if the loan gets funded, in 2 weeks' time, they've got your application, and you should be all set.
Perfect. Thank you.
Great. Thanks, Terry. So based off the poll, I know the vast majority of people have already issued their applications into the banks. However, whether you did that on Friday or Saturday or Monday or even today, that application has changed fairly significantly, as well as the process with banks taking it in-house. So seemingly ever-changing. We don't know necessarily if you'll have to resubmit anything. Most likely, a lot of the banks are going in and saying all right, we've gotten your stuff. We want you to go through our online portal. We're still going to require the hard paper copies of everything, but you're basically going to go through and do a DocuSign, and that's how you're going to certify it. Next slide, please. So we'll go through a few of the application basics and really identify where the changes have been. The top left box, the business structure. When this first came out, I believe there were 2 categories there. It was nonprofit and something else, but it didn't have options for LLCs, C Corps, S Corps. Those have all been added in now. So that's one that's fairly easy for a banker to identify and overwrite in their systems. But some of the other areas are a little trickier. Other things, the purpose down below, we have payroll, we have rent and interest and utilities, and then a category for other. The vast majority of people we've seen have been signing off on the first 3, mostly because those are the criteria that will get you the grant issuance and the forgiveness side of it, where other kind of may open Pandora's box, especially where the expectation is that you're going to explain. We'll run into the calculations and where you can get that information based off either your payroll provider or some of the other options that may be there if you're a smaller business and don't use a payroll provider. And then down below, question number 3 is one that identifies ownership of another company and what that ownership addendum is. So that's just a supplement that you have to add to the back end of this application in the event that you're a owner in greater than 20% in another entity. Basically, it's a blank sheet of paper to just say, this is my name, I am X amount of owner in this, and we have independence between these two businesses. Another item there that's been added since the initials was question 7, and that's the question relating to U.S. residency. So now there is a single line there to say, yes, all of my employees are U.S. residents. They don't have to be citizens, they just have to be residents. And then later on, we suggest a supplemental report that actually drops that down. If you're already in the payroll systems running these, a lot of them have pulled things together to try to make this a bit easier for you. Some of them in the first few days were not as accurate as we would have liked them to be. They've since, as of yesterday, made updates to remove Social Security and FICA. Those have now been eliminated. However, ADP did issue a statement saying, if you've submitted with our prior one, no action is required further. So hopefully that is all squared away now. Page 2 is the certifications page. This is where you go through and everything that Terry kind of ran over. These are the acceptable expenses to use these on. And then one of the questions we've been getting is, who signs this? If I'm a multi-person partnership, it can really be, the requirement is one of the owners or empowered officials. What we've seen on some, if it's a 2-person partnership or something like that, both people just initial down and scribble in an additional signature, but that is not fully required. Next slide. These two really are just the legal jargon running through. All right, we have all these different acts in place, background material that you're more than welcome to take a look at afterwards, so we won't spend time on those. Next slide. And here are some of the offerings that the payroll companies are trying to scramble to get out. So at this time, we know for a fact ADP and Paychecks both have utilities. Both have been updated since they were initially developed. ADP's came out over the course of the weekend. Paychecks came out on Monday, and they both misrepresented what was qualified expense. So as Terry said, some banks are taking a look at things differently. It's all interpretation to the law. So now in this example, hence why I've noted it prior to 4.8, you do see the Social Security and Medicare tax in the center. That is now eliminated. But then one of the other discussions that people have been having is, all right, do I cap my salary at 100,000 or do I cap everything? And it's really only that cash compensation. So for example, if you had someone making $125,000, their calculation would be reduced to $100,000 on that, but their retirement benefits, their match, their profit sharing, their medical expenses would all be added up. So at the end of the day, their total payroll costs could be $130,000 or $140,000. And that does count towards your calculation. The little note on the bottom there is, yes, ADP recognized that they had misrepresented this, and they just want to kind of walk through what the detail is. Next slide. Just because ADP is the largest payroll processor, put in a little contact information. If you do use them, feel free to click on that link afterwards, kind of run through. They have the forms 940, 941, which are both required, as well as the monthly payroll cost and employee headcount reports. Next slide. And this is an example of the Paychecks report. This one handles it slightly differently. The ADP reports take a look at your monthly salary and annualize it to make their exclusions. What Paychecks does is they've aggregated it. So as you can see in the center, there's a total excess comp deducted. That amount doesn't kick in until August. That's when those individuals had crested over the $100,000 of compensation mark. December, the number skyrockets. That's when bonuses are issued. So in this case, the bonuses were issued. The vast majority of those were in excess of that 100,000, and that's why you see the large spike there. A couple of things to note on these, where you take a look at the employer benefits cost. You need to dig in to see what they actually are including there. So in this case, this employer benefit cost was only the 401k match. Now, if you just quickly looked at it, you would assume, oh, there's also a cost of my healthcare being included in there. There was a supplemental report where I could see what was the employer and the employee's contributions on their medical records, and as well as every single employee's eligibility. So that had to be added to this total afterwards. And those are some of the supplemental things that we can run separate reports on to make sure everyone captures and gets the full availability.
Matt, we do have one question. I don't know if it's on this one or the one before, but the one of the questions we receive is, does the state tax column include state WH or just the SUTA tax?
I think it probably depends on which. So that would be.
Go back a slide.
Yeah, it's probably the ADP report.
I think they might be talking about.
Rick, did you say SU? Did you see the state unemployment?
Yes.
I believe it. I believe it's just the it's the state tax.
The taxes, yes.
Okay. Perfect. All right, Matt. Thank you.
All right. So here are some other items that you can kind of run through and try to validate and make sure if you do have one of these payroll providers, they're captured as well. So that example where the company's healthcare expense was not included in the employee benefit deduction, we ran a separate report and added that to the calculation. If you have profit sharing or other retirement benefits that are outside of regular payroll, so at the end of the year, if you issue profit sharing to a secondary account or anything like that, or into their 401ks or retirement funds, that is also eligible. And if there are any commissions that may be issued outside of payroll but are considered taxable income to salespeople who are on your payroll, not necessarily a sales agent from a different company, those would also be included. Some of the requirements to substantiate this really come down to being lender specific, not bank specific, but actual lenders. So as we talk to two different lenders in the same bank, one may want far more information, one may want far less. A lot of it comes down to your relationship with them. If they're comfortable and familiar and they've worked with you for 25 years, chances are they'll have pretty low entry points. If you're a brand new customer to that bank, and they have to go and dig a little further to make sure that the business is viable, you may have to supply a lot more information. So on the medical cost specifically, a lot of times it's a little tough to pull that together, especially because you have employer contributions and employee contributions. So what they've been accepting, we've seen historical invoices, open enrollment calculations where you're showing, all right, employees, this is what the company will pay, this is what you will pay, and even down to general ledger detail to show the ins and outs there, whether when you get your invoice in versus when you're crediting your employee contributions to that expense. And then as Terry kind of noted before, you need to remember once these are funded, keep very, very good track of what you're spending them on. We have been recommending secondary accounts dedicated to this. So when you get your payroll for the first one afterwards and it's $86,000, take that specific amount out of the account to the cent so you can easily reconcile it back into the bank calculations later on.
Matt, one question that we received, I think you might be able to answer right now. A lot of the questions I'm saving for the end. So folks, if you put in questions, some of them we're saving for the end. But one that we got that might be appropriate here is just assuming that you receive a $100,000 loan and you, at the end of the day, can only substantiate, let's say, 90K of it to be forgiven. Is at the end of this nothing more than a simple $10,000 payback, or is there more paperwork processes, any penalties, anything like that?
As you go through the validation process, that $10,000 would then turn into a loan, while the $90,000 would end up being a forgivable amount. So you have a $10,000 loan due over a 2-year period.
Gotcha. Thank you.
Just quickly, so everyone knows, Form 940 and 941 are both required in the submission. If you don't file quarterly, 944 can be issued. That's the annual tax form. Go on to the next slide. And then the ownership addendums, which we kind of briefly touched on, just a statement. Doesn't have to be anything fancy. There's no formal record here. Just identifying if you have the tax ID number, it's probably valuable to add it into that just so they can reference it. And then the employee addresses, even though the addition of question 7 on the application is there, a lot of people are still looking for some sort of support. So the vast majority of payroll services obviously have these pretty well canned. You can draw them down in a couple seconds and send that directly over. One thing to note, when you do pull these, it often carries all master data. So if social security numbers or anything of that sort are in these, that is not necessary to send. So we'd recommend removing those prior to submission.
Matt, I don't know if this is appropriate or right now, or if you want to save it for later, by all means. One of the questions we got was, if you cannot open before the 8 weeks, do you pay your employees to stay at home just in order to get them off of the unemployment system, or should you be waiting until you open to officially go through that process? What are you folks recommending?
I think probably depending on the three of us, we may have slightly different answers, but at the end, it's you can certainly use the 25% of funds to maintain your rent, your utilities. So there's a place for the employees to come back to as soon as possible. And I think there's also a lot of uncertainty as to, is 8 weeks enough time? Yeah. I think it's a very realistic situation that we go longer than the 8 weeks. And if that's the case, I would imagine the government will have to go back and take a look at what the original requirements were, and do they have to amend those? And that really even comes down to region. Arizona may recover far quicker than New York, or up in Maine, where they're not really fully social distance in force right now, versus in Massachusetts where it is in full force. So I think that is one big open unknown right now. But certainly the effort is to try and make sure that employees are getting their regular living wage through this challenging time.
Understood. Thank you.
So then some supporting documents, that these are really just suggestions based off what we've seen. 1099 filings, those make a lot more sense if you're an independent contractor and you're trying to quantify the loan that you're going to issue or apply for tomorrow. But some corporations have also been getting that request from the bankers. So pretty easy to draw. Either your accountant's probably filed it, or even in QuickBooks, you can run down a quick report there and issue those. Driver's licenses of any owners, just proving that they're residents of the US. Banking support qualifying historical payroll draws. That's a new one that's come up, and that hasn't necessarily been required across the board, but it's becoming more and more common. So what they were trying to say is, all right, you've given me this report that suggests you spent $100,000 on payroll. I want to actually see the cash transaction come out of your bank, just as kind of a secondary validation. The payroll report as of 2/15, or the most recent proceeding. So if you don't run it on Fridays, I believe 2/15 was a Friday. If your payroll was on 2/13, we would use that payroll report as of 2/13. Really what it is showing that you were in fact open and paying employees prior to that 2/15 cutoff date. And then legal documents is one that we've seen come up more and more. The articles of incorporation and corporate bylaws, again, to validate the business had all of that structured well in advance of 2/15. Next slide. I'll turn it over to Mr. Anderson.
Yeah, sounds good.
So Mr. Anderson, before we get started, one other question, and you might be able to answer this one as well, but one of the questions we got is, if the company physically can't open until 6/1, can they start paying the employees at that time and start the 8-week process right then and there? I know we kind of talked about it, but you want to just clarify that one more time? If the company cannot open until 6/1, can I start paying the employees at that time?
You can start paying them at that time, but they're not going to meet the 2 requirements unless they modify them.
Okay.
They're and the calculation they applied for was probably should have taken that in consideration.
So in other words, they might not be able to spend everything that they applied for.
Correct. If they didn't somehow adjust what the calculations were, and then most sure that would have been a mistake because that would have just been kicked out. But they did not allow for any of that, and I would assume that they can't open to June 1st. That's because that same reasoning would be in effect if there was this crisis or not. So they really don't have any salaries that they need to get reimbursed for paying. So at least that's my take based on what the intent and what the specifics of the law states. But again, they could certainly relax that.
Got it. Thank you. Sorry, Matt, for interrupting.
Yeah, no problem at all.
All yours.
Yeah, so it was a good introduction. So we're going to kind of switch gears a little right now and talk about the tax law changes relative to the CARES Act. So Terry and Matt went through really the main crux of it, getting basically that forgiveness on the loan. So that's going to be huge. So really when a loan is forgiven, it's included in taxable income. So that's what you're basically avoiding here. And that's kind of the tax end of it. So you put it to payroll, you'll have it forgiven. There's going to be no taxable income. So with that and a lot of the tax law changes that we're going to go through, the main essence is to free up cash. So the government really saw this as taxpayers, basically you're in chaos. It's really survival mode right now. You don't know about your suppliers, your dealers, you don't know when employees are showing back up to work, just a lot of questions that you have. So one area that you can control is basically your tax return filings. And like I said, a lot of what we're going to be looking at is potentially amending prior year tax returns to get benefit back to you. So really what we're talking about here is increased deductions, which means it decreases your tax, which means it increases your cash flow. So less tax you're paying, more cash in your pocket. So next slide and we can start to go into it here. Really, before we jump into a lot of it, I just want to, mainly it's the middle part of this form that I want to go through, but as we all know, the income tax deadline has been extended. So what returns were normally due on April 15th are now due on July 15th. So that's an automatic extension, really nothing you have to do. That applies to individual returns, trusts and estates, corporations. Recently, they added gift tax returns to it. What it doesn't include, and why I just wanted to bring up this slide, is estate tax returns. So that's a net worth aspect there. So it doesn't fall under income. So that's why there's no relief given there. Partnerships and S corporations, those were due back in March. So again, there was no relief given to that. You might have filed it already or put it on extension. So again, they might be due come sometime in September if it's on extension. But again, no relief provided under this here. Fiscal year returns, or if you file a 990s due on the May 15th date, we're just talking about April 15th return. So if it's a different due date, that doesn't apply here either. And payroll and excise tax returns, again, it's not income tax related, those are payroll related. So again, those are the items. So I just want to list those as well. I know everyone's talking about, oh, things have been extended. A lot has, but a lot hasn't as well. Really, to get into it, these are tax savings items here. Oh, sorry, just on the last slide, if you just want to go back for a second. At the bottom, Massachusetts has different rules too. So just be cognizant of state tax law as well. So I know we're in Massachusetts here. I know most of us are. Be wary of C corporations. So Massachusetts conformed for most, for individuals. They didn't conform to C corporations. So the due date for those are still April 15th. There's other relief that Massachusetts granted relative to C corporations, but kind of the guidance is file an extension, pay what you can pay in there, and then maybe you have some type of payment agreement with Massachusetts to make up the difference. But just be wary of that as well. So just point to note. Kind of getting into it a little more here. So there's a payroll tax credit that's also available. So again, the essence of this is freeing up cash for employers that they can turn around and pay to employees. So eligible entities, those would be, you'd either have some type of suspension in activities, and that's very real now for a lot of businesses, or there's a decline in gross receipts. So maybe you still are in business, but when you look at your gross receipts from this quarter of last year, if they're down 50%, this will apply to you. So again, this won't apply to every company, but those are pretty big buckets to fall into or apply to most. The credit itself is related to, again, payroll taxes. This is not an income tax related relief. This is related to payroll taxes. So you're going to be working with your payroll company to get this credit, to substantiate this credit. And it's relative to the Social Security piece. So the employer's 6.2% of wages. That's the amount that we're talking here where the benefit's going to be.
Now, is this something that people are typically applying for, or their payroll company proactively reaching out to them, or is it automatically?
Yeah, there's kind of a progression here, and actually, you go to the next slide. I can kind of walk through it.
Yeah.
For it, back one, please. I think you skipped to here. Yeah. So, the credit itself is $10,000, but it's 50% of that, which you get it. So the $5,000 credit off of $10,000 of wages. So just kind of walk this through as an example. So say you have one employee, they make $40,000. So you pay them $10,000 per quarter. For the most part, Q1 of the year is going to be the same as it was before. This pandemic came out mid-March. A lot of these provisions that we're talking about here go into effect April 1st. So for Q1, it's basically the same as it's always been. You're filing your 990s, your 940s, 941s for payroll. Q2 comes along, and that's where this payroll protection loan would come in. You'll get some benefit for that. Q3 comes along, and this is where you might then get this benefit of this credit here. What they don't want you to do is to double dip. So since you're getting the loan forgiveness for the loan, they don't want you to get a $5,000 credit here as well. So Q1, like I said, business as normal. Q2, we're just assuming your business was, one of the other provisions was able to get some relief. So again, you can't double dip. Q3 comes along and, okay, here's my employee that I have. I paid them $10,000 in wages. At this point in time in Q3, I can then file for this credit, and it's related to your payroll form. So it's to get the credit, it's form 7200, so 7200, and that's where this credit is going to be captured on it. Really, there's not much more guidance that have come out to this. Really, attention has been put to the loan itself, the payroll protection loan. So really, this is really an afterthought right now. We'll be getting more guidance on the future. And just to follow up my scenario, say in Q4, you pay this person, again, $10,000. You already got the maximum credit for that person for that $10,000 in Q3. So again, you can't get another $10,000 in Q4. So it's a pretty good benefit. It's kind of a one-time, really $5,000 if you're paying someone more than $10,000 in the quarter that you're going to get per employee. So again, a very, very, very big influx in cash flow for you here. Item number 4, the credit, again, is for 2020 itself. It ends on 1/1/21, and it was the effective date of 3/12/20. Big item to also note that once you open for business, really this doesn't apply anymore. And if your gross receipts go above an 80% test. So remember on the first slide, one of the criteria to fall into this was you need to have gross receipts fall below 50%. If they raise to 60, 70%, you're good. Once they go over 80%, you can no longer capture this credit. So if that happens sometime in Q3, where that $10,000 in just my example that I just ran through quickly, you paid someone $5,000, unfortunately, your credit would be only based upon the $5,000, 50% of that rather than $10,000.
Got it.
Number 5, again, that was kind of my example where you can't double dip here. If you get loan forgiveness, you can't get this credit as well on top of it. Big thing to note too in number 6 is relative to your employee size. So if you're under 100 employees, any payroll that you pay is qualified. If you're over 100 employees, it's only the wages when you were shut down that would qualify for these. It's not all your wages. So I know most will fall under the 100 employee test where they all would qualify, but just for those employers over 100, just be cognizant of that too, that this goes into the formula. So that's kind of really main item 1 that you could fall into. The next here is related to that, and it's basically a deferral in your payments. So going back to my example, we talked about Q1, business is normal. Q2, we're saying, okay, you've had some type of forgiveness. Q3 comes along, you're able to use that credit that we just talked about, the retention credit. Now Q4, you need to start paying these taxes again, since nothing really applies. What they say is, okay, we'll allow you to defer the employer piece. 50% of it is going to be payable in the end of 21, and the remaining 50% will be payable again in the end of 22. So really this provision is giving you, again, just more cash flow into the business where you can suspend those payments out. They'll be due eventually, but you can suspend them out, delay it a little, and pay the employees their wages for it. If you're self-employed, again, the self-employment too would kick in, where you take whatever self-employment that you paid. So it's Form SE when you file a 1040. It would be 50% of the amount you can basically defer out as well. So 50% of that SE amount would be payable at the end of 21, and then the 50% would be payable in 22. So those are self-employment individuals. Those, if you file a Schedule C.
Got it.
Now just moving in through some more of the provisions. If you're a corporation, there's net operating losses. So the rule that was in effect for the longest time was you could carry back an NOL 2 years. For 2 years, Tax Cut and Jobs Act came through and said, no, we'll just allow a carry forward. So if you had zero income in a year, you pay zero taxes. If you had $100,000 loss, you pay zero taxes. So the benefit there, the $100,000 loss, is essentially vanished. So again, to free up more cash, basically government said, hey, we'll allow you to carry back that NOL 5 years. So you can amend 2018 if you filed already a 2019 return to carry back that NOL. So again, that $100,000 you can carry back 5 years. So a loss now, if you had income in 2013, you could pull it back potentially then on a 2018 return. So again, just huge tax savings if this is something that applies to you with these losses. In 2020, we're just anticipating huge losses. So again, you're going to be able to free up a lot of cash from that. So again, amending returns is again the key here. One question we received here. I perceive the answer is going to be no, but were the 1099s e-filing extended as well, or because that was supposed to be done? Yeah, that was due, back in January. Yep, exactly, yep.
Okay, so that was not extended. Got it, thank you.
So there, we just talked about kind of a corporate loss. If there was a business loss, so again, this is a new item that was passed by the Tax Cuts and Jobs Act, and best way to explain this is going through an example. We had a client that they opened one of those indoor facilities, trampoline parks, entertainment areas, that type of. They spent about $600,000 on improvements. Unfortunately, they had a loss of $600,000 for the year. They opened up like December, had no income. You can only take, and again, this is just what was enacted. If you're married, you can only take $500,000 of that loss. So they had other income. I'll just say they had $600,000 of income. They had $600,000 of losses from their entity. You would think that would net out to a zero tax. With the Tax Cuts and Jobs Act, they basically say, no, we're going to limit that loss to $500,000. Unfortunately, you need to report $100,000 of income in this year and have a $100,000 carry forward of a loss that you can file against future years. So really made no sense. So again, if that was something, mainly it would be some significant event, or if you had significant losses, you could potentially amend prior year returns to get back more of that loss and have it apply. So again, another one, freeing up cash by amending prior year returns. Just quickly at the top, the AMT credit that applied to corporations, the Tax Cuts and Jobs Act, again, back in 2017, switched it. You can basically accelerate that credit. Before it was kind of prorated based upon a bunch of different factors. You can get the entire credit back in 2018. The alternative, if they didn't pass this here now, was 2021. You would have been able to get those credit back for the most part. Again, at the bottom of the form is the business interest limitation. Don't want to spend too much time on it because it's for companies over 25 million, but they raised a hurdle from 30% to 50%. So essentially they're saying basically more interest you can deduct, more you can deduct, decreases your taxes, better for you, more cash flow that you have.
Now, somewhat appropriate here, I figured I'd ask. We had a question that a couple of people have heard that you only have 10 days to have the loans funded, and I believe they're talking about the PPP loan funded after approval. Otherwise, the funds go back into the pool. Is that true? Have you guys seen that or heard that about the 10-day time frame?
There is a 10-day time period that they want the banks to fund it once it's approved. But again, that's not going to happen. I don't think it's going to happen. We've already been, told by banks that, it might take a couple of weeks because there's a lot of applications coming in. They have to do the documentation. Money has been put aside, and then they have to have people, however they're going to have people sign off, either in person or notarized or just with a doc sign before it's funded. So I don't know necessarily if the money has to be given back. It's not like you didn't take it. It's not available to you.
Okay.
I did see something just this morning in regards to a 10-day window of use of funds. So once the bank does fund the individual or business, the expectation is that within 10 days, they will start to spend on that. And that would trigger the 8-week time period going forward. But that's certainly subject to change as well.
Got it. Thank you.
And so these are kind of the final two big items, and they probably have the most bang for the buck here too as well, that you could have and most applicable. Qualified improvement property, there's a mess up that they had when they wrote the Tax Cuts and Jobs Act back in 2017, where it was intended to be 15-year property. They moved it to 39-year property. So basically fixed it here where it's now 15-year property available for 100% bonus depreciation. So really what this means is if you had, if you're a restaurant or had some type of interior improvement, kind of think of it more, not structural, but kind of an office layout. If you're just putting up like temporary walls in offices, it's now 15-year for that. So a lot of those outfits that would see prior years, and this is retroactive. So we're not talking 2020 here. You can pull this back a few years. You can amend returns and basically get 100% bonus for that. So instead of depreciation over 39 years, we're getting 1/39th of these building improvements. You can basically backdate this and say, hey, I'll get 100% of those improvements that I had back then. So huge. Again, we're not sure if you're going to amend returns here or if there's going to be some type of other adjustment the IRS comes out with. Again, this is huge, so I'm not sure they want to see. Probably every fifth client that we had qualified improvement properties. So I'm not sure they want to see those amended returns. But again, we'll see where this goes. Last one is
what adjustment is.
Go ahead, Terry.
Yeah, Matt, tell them what a 481 adjustment is.
Oh, sure. Yeah. Relative to this qualified improvement property, you took just say $1,000 of depreciation in the past because it was over 39 years. So you have $99,000 worth of basically property left here that you're going to depreciate. You'd get an immediate deduction under a 481A adjustment in the current year for $99,000, the difference of it. So the alternative is you basically carry it back and amend prior year returns to claim the full $100,000 then. So that's what a 481A adjustment is. For retirement plans, again, this is from a more an individual angle on it, but definitely can be utilized for small business owners here. Is they're allowing you to take up $100,000. It needs to be related to the pandemic from distributions from your retirement, and you avoid the 10% penalty, the early withdrawal penalty. It is still taxable, though. Basically, you put it in pre-tax to some IRA. You're pulling it out now, so you're going to be taxed on it. But then on the back end, they said, we'll give you 3 years to basically recontribute that back in and waive basically that taxable income portion. So they're treating it as more like a rollover in that 3 years. So if you pull out $100,000 now, 3 years from now, if you contribute the $100,000 back in, the 10% penalty won't apply and it won't be included in your taxable income from that. So last bullet on the bottom two, the loans you have increased. Before it was a maximum of 50, it can be up to 100,000, and that really depends on your plan. You'll need to look at that if a loan is available in your plan or not. That's good for that slide. And I think just one more bullet on the next slide, and that's it.
Rick, it looks like tech issues going on here.
Yeah, a couple people said that their video was frozen. We are recording the video, so we'll continue on, and if anybody. We'll make sure everybody gets a copy of it as well.
Okay.
On to the next slide, Matt.
Yeah, and just a real quick item. So we kind of ended in a good spot. Basically, if you have an employment plan already where you had a loan and you're making payments on it, they've extended that for a year. So again, cash flow wise, you don't need to make any payments back on that. And then if you had any minimum distributions from your IRA that you're receiving, that has been suspended for a year as well. So people don't need to pick them up taxable income from their retirement accounts. It's been suspended out. So again, a little additional cash flow.
Perfect. I'm going to let people just know that they can exit and reconnect. A couple people said that was helping them out. So give me 2 seconds. I'm just going to put that out for everybody. If you did get disconnected, you can go ahead and jump back out and jump back in. So, all right, we'll continue on. I think we're almost at the Q&A section. All right, perfect. Gentlemen, any final thoughts or recaps before we get into Q&A? Anything else that you wanted to cover?
I think we've got most of it covered. If there's any Q&A, I mean, that's really what's important, right? For your listeners here, participants, to get answers to their questions.
Exactly. So if you guys have any questions at all, now's a great time to put those questions in there. Anything we haven't covered or anything you want to go through, I'm going to go through a couple of the questions we have now for you gentlemen. One of the questions we receive, you mentioned 501c3s are eligible. One of the questions is that the only form of nonprofit, or things like 501c6s and things like that, are they eligible as well?
No. So it's a 501c3, and there's another nonprofit that has to do with Veterans Administration or veterans, but that's it. There's no other subsect C that qualifies.
Okay. And I think you covered this. The attendee said they may have missed it, but how do I calculate the average payroll if my business just started in October and I've added 2 employees after February 15th?
So in that case, you would run the payroll cycle. I should have gone into more detail. So as Terry said, some banks are saying we'd like 2019 full year information. When it originally came out, they said they wanted through the trailing 12 months through 3/31. So whatever your period of payroll is, if you can run that through to 3/31, and then however many months you had, use that to generate your average.
I think we need to get a clarification. We'll have to get back, Rick, that maybe you can let the listeners know. I think that if you weren't in business during the time periods in 2019, for looking back retroactively, that it might be January, February of 2020. You're taking an average there. I can verify that. We can verify that and let you know, so you can let them know when before you send off the copy of the recording.
Perfect. And obviously your contact information is on the screen, and I can share that information when we send it out as well, so they can reach out and ask questions directly if they want to. Another question we have is the disaster loan assistance grants, 10K, a separate program? And if it is, can you do the PPP and not this grant, or both? Do you have to choose, that kind of thing?
You can do both. You would go into the disaster loan as long as that, and apply, and as long as you're not using that $10,000 to fund the same cost you're funding here, because that's is disallowed, that portion of it. But you can go into the other disaster loan and get the $10,000, and if you qualify and they after they're going through what the application process is, and you do that right online directly to the SBA, that if you're for whatever reason disapproved, that $10,000 doesn't have to be paid back, because they're supposed to advance that within 3 days of the application being filed.
Got it. So as long as you can prove the funds were used separately, you can absolutely apply for both, it sounds like.
Yeah.
One of the questions we got is, it says, I have a concern. If the bank does take longer than 10 days to complete the closing process and fund, will the SBA reverse their approval, and will they need to reapply? How does that work, and do we know?
It hasn't been defined. My best judgment is no, they won't reverse it. They want people to have money, and they understand there are some delays that are outside of the control of the borrowers, the business owners. So I don't see that happening.
Okay. Perfect. I'm just going through. All right. Last couple seconds to ask any questions, but I think I tried to do my best to filter questions to you as they came throughout the presentation. I think you guys did a great job answering them. I will wait just a couple more minutes to see if we get any follow on. But first off, I want to thank both the Matts and Terry for being on. I appreciate it. It was a great presentation. You answered a lot of questions I know that I had, and I'm sure a lot of our customers had as well. So really thank you to you guys. Thank you to S&G. You guys have been a great resource for myself, my businesses, and certainly for everybody here today. I'm sure we'll see you in future Cinch series, and we'll be lucky to have you back. Honestly, to all of our amazing clients that are on the line, thank you so much for your partnerships. It truly is a pleasure for all of us to support you guys. And we look forward to seeing you guys in the next Cinch series. Hopefully you guys found this very helpful. And if you have any questions at all, reach out. Again, I will send a video of today's presentation to all of the attendees as well. And with that being said, I will let people drop off. I do have one more question that came in. We can answer it if you got a couple minutes, gentlemen. But otherwise, we'll see everybody a little bit later. The last question we have, hopefully this might be the last one. It says, I also applied for the disaster economic loan. Should I not have? And it sounds like you said, as long as you can prove that you're using the funding sources separately, that's completely okay. Is that correct?
Yeah, because the disaster loan, it can be used for working capital. It can be used to pay off other debts, actually even acquisition. So there's quite a few things that you can use it for. Pay old bills that have accumulated. So yes.
Perfect.
That one we would probably definitely recommend a more defined separation of cash funds to make sure that certain ones go certain places and there's absolutely no mixing.
Perfect. Well, gentlemen, thank you again very much. We'll see you guys soon. Thank you, everyone.
Thanks, Rick.
Thank you.
Bye-bye.
Bye-bye.